Thank you very much. Good morning, and thanks for having me. Indeed, it's quite encouraging, actually. Investors were unfazed by this big repricing of rate cuts from the core center banks, particularly the Fed, where at the beginning of the year, markets were pricing in nearly 7 rate cuts of each 25 basis points from the Fed. This has come down to 3, if not less, throughout the first quarter. And emerging market investors were unfazed. I mean, you might argue this is valuations. You might argue this is the excitement that down the road, as the year advances, the rates will come down. That's the guidance from the Fed and other core center banks. As a matter of fact, we ask investors in the survey, what is the biggest upside risk? What is the biggest downside risk? And on either side, investors say it's the global monetary policy outlook and the fact that core center banks will start cutting rates as per their current guidance was actually encouraging for investors. And it's not only the sentiment that has evolved, modestly bullish, it's also the cash levels have come down. We also have a risk appetite score in every survey, every quarter, where 0 is no risk in EM and 10 is the highest risk. And that score on a weighted average basis has also improved to the highest of 1 year. I think it's the excitement that, sometime this year, obviously this keeps changing, that the core center banks will cut rates is why investors have turned modestly bullish.
I mean, you say that the emerging markets were unfazed by sort of the gradual paring back of rate cut expectations, but the developed markets were equally unfazed until they reach a point where they're like, oh, actually, you know what? We were hoping for 6 originally, then we got to 3, and then maybe it might be only 2, and then, goodness me, it could be even like at the end of the year. Do you think that maybe there could be also less bullishness in the next 3 months for emerging markets if they come to the same realization?
Well, it's a fair question, and obviously everything has to be reassessed as we have more incoming information. But perhaps at this stage we can go a little bit granular. I mean, yes, they're modestly bullish. Well, where are they bullish? And it's still Latin America, and this has been the case for many surveys that Latin America has what we call a net positive sentiment score across all asset classes. It's actually only Asia where investors are more bullish on equities. But for the rest, it's Latin America, and that's partly because most of the countries across the region, they've managed to bring inflation broadly under control. There is very high real interest rate buffer. They're cutting rates. Growth outlook is good. External balance are fine. So yes, perhaps we should look at things a little bit more granular, more bottom up where they are bullish. And it's mostly Latin America, followed by Asia for the equity markets.
Indeed. Let's get granular. Why was it that Latin America stood out?
Sure. Well, look, broadly speaking, of course, we have an election coming up in Mexico later in the year, but broadly speaking, we have left the election cycles, especially for Southern Cone, behind us over the past few years. So politics is less of an issue. The external balance are pretty strong, especially when it comes to Brazil. Trade balance breaks record almost every month. And I think the linchpin is, while a lot of developed world center banks were thinking that inflation might be transient in the beginning, many Latin American countries have embarked on a tightening cycle. Brazil, for instance, is a case in point, 1 year earlier than the Fed. And they have, pretty drastically raised rates to very high real interest rate levels. And they're actually seeing the benefits of that. They're reaping the fruits that inflation has really fallen very, very low, near target, still very high real rates. That offers both nominal and real carry for investors. And together with a decent external picture, for their current account balance, good FDI inflow. And also, even on the fiscal side, there has been some improvement. I think investors are looking at a better macro mix relative to the others, of course. It's all about relative strength on the macro balances and good yield on offer, both in real and nominal terms. That makes it quite attractive, which is then followed by Mexico, where you can actually tell a similar story. And obviously, the icing on the cake for Mexico is the cycle is so integrated with the U.S. that U.S. economy remains resilient and strong. Every month, U.S. labor market holds up strongly. Mexico receives substantial remittances, more than $5 billion. There's tourism revenues. There's, friendshoring, nearshoring related FDI inflows, and public debt is much lower, actually, compared to the rest of Latin America. So it's really the good macro mix that stands out.
As for